Assalamualaikum to Prof. Dr. Aisha. We are from Group 9. We'll be presenting of our analysis of financial performance of Astro and Media Prima. This is our team. Alright, I will explain the company background first. I will start with Astro Malaysia. Astro Malaysia Holding Berhad is a leading media and entertainment company in Malaysia, operating mainly in the broadcasting and digital content industry. Its core business focuses on subscription-based television services supported by digital streaming platforms such as Astro Go and Suka, as well as radio broadcasting. Astro also plays an important role in content production and advertising, producing both local and international programs. The company is selected for this study due to its strong position in the pay TV market and its successful transition towards digital platforms. Next, I will explain the Media Prima Berhad's company background. Media Prima Berhad is Malaysia's largest integrated media company, operating across free-to-air television, print, radio, and digital media. Media Prima is well known for television channels such as TV3, NTV7, ATV, and TV9. Its business model mainly relies on advertising revenue and content production. Media Prima is chosen for this study because of its strong presence in free-to-air broadcasting and its ongoing digital transformation. Next, we will present the analysis of the financial performance of both companies.
This slide explains the liquidity position of Astro Malaysia Berhad using the current ratio, which measures the company's ability to meet its short-term obligation. From 2020 to 2021, Astro showed a slight improvement as current liabilities decreased. However, between 2022 and 2023, the ratio dropped significantly due to a sharp increase in short-term borrowings and payable, mainly caused by industry challenge and digital competition. But in 2024, Astro liquidity improved strongly after reducing its current liabilities through debt restructuring and better working capital management. For Media Prima Berhad, the current ratio remains stable from 2020 to 2023, staying between 1.10 and 1.14, which shows consistent short-term liquidity. In 2024, the ratio increased to 1.37, indicating a stronger ability to meet short-term obligation. This improvement was mainly due to a significant reduction in current liabilities, likely from debt repayment and more efficient working capital management. Overall, Media Prima demonstrates a more stable liquidity position compared to. This slide shows Astro Malaysia Berhad quick ratio, which focused on its most liquid asset. From 2020 to 2021, the quick ratio remained healthy, indicating strong short-term liquidity. However, the ratio declined sharply in 2022 and 2023 due to lower cash balance, higher short-term debt, and difficult in collecting receivable. In 2025, the quick ratio recovered to 1.02 as Astro leveraged its cash reserve, maintained investment holding, and improved receivable management, reflecting better short-term financial control. For Media Prima Berhad, the quick ratio declined sharply in 2021, falling from 0.68 in 2020 to 0.34. This was mainly due to a significant drop in cash balance, likely caused by operational cash outflows or investment activities. Although the ratio remained low in the following years, it showed a clear recovery in 2024, rising to 0.74. This improvement was supported by higher cash levels and a reduction in current liabilities, indicating better short-term liquidity management. Based on this chart, Media Prima Berhad consistently recorded a higher current ratio throughout the period, which reflects a more conservative working capital strategy. The company focused on maintaining sufficient current asset rather than pursuing aggressive expansion, which helped strengthen its short-term liquidity position. Media Prima's operations are also relatively more stable and less capital intensive, allowing current assets to remain above 1.10 ringgit for every ringgit of current liabilities. In contrast, Astro Malaysia Berhad recorded a lower current ratio over the same period. This is mainly due to its capital intensive business model, which required significant investment in content and broadcasting infrastructure. So in addition, Astro's subscription-based revenue and reliance on short-term financing placed greater pressure on its working capital and short-term liquidity. So based on this bar chart, Astro Malaysia Berhad generally recorded a stronger quick ratio throughout the period, except in 2024. This indicates that Astro holds a higher proportion of liquid assets such as cash and marketable investment, which improve its ability to meet short-term obligations without relying on inventory. Despite facing operational challenge, Astro maintained relatively strong cash management, and its investment holding provide additional liquidity support during period of financial pressure. So in comparison, Media Prima Berhad recorded a weaker quick ratio. This was mainly due to lower cash balance and a more aggressive use of cash in its daily operation. Media Prima's asset relied more on receivable and inventory rather than highly liquid asset, and its smaller scale of operation limited its ability to maintain large cash reserve, which affect its short-term liquidity position.
Next, I will be explaining the asset management ratio, which include total asset turnover, inventory turnover, and receivable turnover for the period from 2020 to 2024. To begin with, in 2020, a meaningful analysis could not be conducted because data for all three ratios was not available. Therefore, this year served only as a baseline before comparison can be made in the following years. Moving on to 2021, the company showed relatively good efficiency in managing its assets. The total asset turnover was 0.72, indicating the company's ability to generate revenue from its asset base. The inventory turnover was extremely high at 210.8 times, suggesting very fast inventory movement. Meanwhile, the receivable turnover stood at 5.14 times, reflecting a moderate efficiency in collecting payment from customers. In 2020, the total asset turnover improving slightly to 0.75, showing better asset utilizations. However, the inventory turnover declined to 168.3 times, indicating slower inventory movement comparison to the previous year. On the positive side, the receivable turnover increased to 5.45 times, showing improvement in the debt collection and efficiency. For 2023, the total asset turnover decreases to 0.69, suggesting weaker asset efficiency. The inventory turnover continued to decline to 126.2 times, reflecting slower sale or higher inventory, indicating more effective management or receivable. Finally, in 2024, overall performance showed as a downward trend. The total asset turnover fell further to 0.59, and the inventory turnover declined slightly to 123.3 times. The receivable turnover also decreased to 5.13 times, suggesting a slight weakening in collecting efficiency. Next, based on the graph shown, we can observe Astro asset efficiency trend from 2021 to 2024. First, the total asset turnover increased slightly from 2021 to 2022, indicating improved efficiency in using assets to generate revenue. However, the ratio declined for 2023 onward with a sharper drop in 2024, suggesting reduced effectiveness asset utilization, possibly due to slower revenue growth or higher asset level. Next, the inventory turnover graph showed a steady decline through the period, while the higher turnover in 2021 reflected efficient inventory management. The continuous decrease from 2022 to 2024 indicated slower inventory movement, which may result from weakness demand, overstocking, or less efficient inventory control. Lastly, for receivable turnover graph, it improved from 2021 to 2023, indicating more efficient collection of receivable. However, the decline in 2024 suggests slower collection of payments, possible due to declined customer payment or weakened credit management. Overall, efficiency improved before weakening in the final year. Next slide is asset management analysis for Astro in 5-year comparison. In 2020, no comparable data, no asset management analysis could be made due to unavailable data. This year served as baseline for future comparison. In 2022, strong asset and inventory efficiency. Astro show strong asset efficiency with a total asset turnover of 0.72. Inventory turnover was very high, indicating efficient inventory management, while receivable turnover showed reasonable collection efficiency. In 2022, improved asset utilization but slower inventory movement. Asset utilization improved slightly with higher total asset turnover. Receivable collection become more efficient, but inventory turnover declined slightly, show inventory movement. In 2023, declining asset and inventory efficiency. Overall, asset efficiency declined as total asset turnover fell. Inventory turnover continued to decrease, although receivable collection remained strong. And last, 2024, weakness asset efficiency over the period. Astro recorded its weakness asset management performance with the lowest asset turnover and continued decline in inventory efficiency, indicating growing operational challenges.
Now, let's take a look at debt management ratio of both companies, Astro Malaysia Holding Berhad and Media Prima Berhad. So let's take a look at Astro first. From the table, Astro's debt-to-equity ratio does improve over time. It drops from 6.24 in 2020 to about 3.92 in 2024, which shows Astro is slowly reducing its debt level. But overall, the ratio is still quite high, meaning Astro is still heavily dependent on debt. This is quite common for media companies because of high infrastructure and satellite lease costs. However, the issue appears in the interest coverage ratio. We can see a clear downward trend from 5.13 times in 2020 to just 1.21 times in 2024. This means Extro is barely able to cover its interest expenses. In simple terms, most of its operating profit is being used just to pay interest, which increases financial risk. Now, we take a look at Media Prima Berhad's debt management ratio. Media Prima's debt-to-equity ratio keeps going down, from 0.77 in 2020 to 0.40 in 2024. This shows the company has significantly reduced its debt and is now mainly financed by equity. The interest coverage ratio improved massively. It jumped from 0.91 times in 2020 to 26.71 times in 2024. This means Media Prima earns more than enough to pay its interest, and interest costs are no longer a major concern. Overall, Media Prima is in a much stronger and safer financial position. So, if we compare both companies in terms of debt management, Astro is highly leveraged. Even though its debt level has reduced, its ability to pay interest has weakened, making it financially riskier. On the other hand, Media Prima shows excellent debt management. It has low leverage and very strong interest coverage, which indicates high financial stability. In summary, Media Prima performs better than Astro in terms of debt management and financial risk during the period analysis.
This slide shows the net profit margin of Media Prima Berhad from 2020 to 2024. In 2020, the company recorded a very negative profit margin of minus 84.02%, mainly due to significant losses despite having sales revenue. In 2021, there was a strong recovery with profit margin increasing sharply to 82.82%, indicating effective cost control and improved profitability. However, from 2022 onwards, the profit margin declined to around 50% and further dropped to 30.55% in 2024. This trend suggests that although the company remains profitable, rising costs or lower income have reduced overall efficiency, generating profit from sales. These slides present the return of asset of Media Prima Berhad over 5 years. In 2020, ROA was negative at minus 4.53%, showing inefficient use of asset due to net losses. In 2021, ROA improved significantly to 5.22%, reflecting better asset utilization as the company returned to profitability. The ratio remains stable at 4.57% in 2022 and 2023, indicating consistent performance in generating income from assets. However, in 2024, ROA declined to 1.98%, suggesting that asset growth was not matched by proportional profit growth. This slide shows the return on equity for Media Prima Berhad. In 2020, ROA was negative at minus 7.61% due to shareholder losses. In 2021, ROE improved to 7.92%, indicating stronger returns to shareholders following financial recovery. The ratio then declined slightly to 6.32% in 2020 and 2023. Showing stable but moderate shareholders' returns in 2024, ROE dropped further to 2.78%, which suggests reduced profitability and lower returns generated from shareholders' equity. This graph shows the net profit margin of Media Prima from 2020 to 2024. In 2020, the company recorded a negative net profit margin, which indicates that Media Prima was making a loss during that year. However, in 2021, there was sharp improvement, where the net profit margin increased significantly, showing strong recovery and profitability. In 2022 and 2023, the margin remained stable at around 50%, which suggests consistent cost control and operational efficiency. Finally, in 2024, the net profit margin declined slightly but is still positive, meaning the company remains profitable. Overall, this graph shows that Media Prima managed to recover well after 2020, although profitability weakened slightly in 2024. This graph illustrates the return on assets or ROA of Media Prima from 2020 to 2024. In 2020, Media Prima recorded a negative ROA, indicating that the company was not using its assets efficiently to generate profits. In 2021, ROA increased sharply to above 5%, showing a strong improvement in asset utilization. From 2022 to 2023, ROA remained relatively stable, which suggests consistent performance in generating income from assets. However, in 2024, ROA declined to around 2%, indicating reduced efficiency in asset usage. Overall, the graph shows that although Media Prima improved significantly after 2020, assets efficiency weakened in the most recent year. This graph shows the return on equity or ROE of Media Prima from 2020 to 2024. In 2020, the ROE was negative, meaning shareholders did not receive returns due to company losses. In 2021, ROE increased sharply to around 8%, showing strong returns for shareholders. In 2022 and 2023, ROE remained stable at around 6%, indicating consistent profitability and effective use of shareholders' equity. However, in 2024, ROE declined to approximately 3%, suggesting lower returns for shareholders. In conclusion, Media Prima showed strong recovery after 2020, but shareholder returns have weakened slightly in 2024. This slide shows Media Prima's profitability performance over a 5-year period. In 2020, the company recorded heavy losses due to the pandemic. Net profit margin, RA and RE were all negative, indicating weak profitability and no shareholders' returns. In 2021, Media Prima made a strong recovery. All profitability ratios turned positive and reached their highest level, driven by economic reopening, digital growth, and better cost control. However, in 2022 and 2023, profitability remained positive but started to decline. This suggests weaker assets efficiency and lower shareholders' returns, mainly due to increasing digital competition. By 2024, profitability continued to fall across all ratios, highlighting ongoing challenge in sustaining the strong performance achieved in 2021. Overall, the trend shows a sharp recovery followed by gradual profitability pressure.
I will continue with market value ratio. The first one is earnings per share. For Astro Malaysia Berhad, we can see the EPS decreased continuously from 2020 to 2024. This means the company's profit per share is getting lower each year. The decrease shows that Astro's profitability is declining over time. For Media Prima Berhad, we can see the EPS was negative in 2020 due to losses. However, from 2021 to 2024, the EPS remained positive and stable. This shows that Media Prima has better earnings consistency in recent years. Next, market value ratio for price earnings ratio, PE ratio. For Astro Malaysia Berhad, the PE ratio shows a mixed trend from 2020 to 2024. The PE ratio increased in 2021, showing higher investor confidence. However, it decreased from 2022 to 2023 due to lower earnings. In 2024, the PE ratio increased sharply because the earnings per share became very low. This shows that Astro's profit performance weakened over time. For Media Prima Berhad, the PE ratio was negative in 2020 due to company losses. From 2021 onwards, the PE ratio became positive and more stable. This shows that Media Prima recovered and started to generate profit. Overall, Media Prima shows a more stable performance compared to Astro. Next, justification period for earnings per share. For earnings per share, Astro Malaysia Berhad recorded a higher EPS in the earlier years, especially from 2020 to 2022. However, we can see a continuous decline in EPS until 2024. This suggests that Astro is facing pressure in maintaining
its profitability, possibly due to higher operating and content costs in a highly competitive media industry. On the other hand, Media Prima Berhad started with a lower EPS in 2020, but its EPS gradually improved from 2021 onwards and remained relatively stable. This indicates better cost management and a more sustainable earnings performance in recent years. Overall, although Astro performed better in the yearly period, Media Prima shows stronger EPS stability in the later years, making it more resilient in terms of profitability. For justification, PE ratio, for the price-earnings ratio, Astro Malaysia Berhad shows a relatively stable PE ratio from 2020 to 2023, before increasing significantly in 2024. This increase suggests higher market expectation towards Astro's future earnings growth, even though its recent profitability may be under pressure. Meanwhile, Media Prima Berhad recorded a negative PE ratio in 2020, which indicates losses during that year. However, from 2021 onwards, its PE ratio turned positive and remained stable, reflecting a recovery in earnings and improved investor confidence. Overall, Astro's higher PE ratio indicates stronger growth expectation from investors, while Media Prima's stable PE ratio suggests more consistent and cautious market valuation. I will continue with investors' perspective and stock valuation. From an investor perspective, Media Prima Berhad appears to be a more stable investment due to its consistent EPS and moderate PE ratio. This suggests a lower level of risk and makes the company more suitable for long-term investors. In contrast, Astro Malaysia presents a higher level of risk to investors. The decline in EPS and the increase in the PE ratio in 2024 indicate that the stock price is relatively high compared to its current earnings performance. In comparison, Media Prima Berhad is more attractive to investors who prioritize stability, while Astro Malaysia may appeal to investors who are willing to accept higher risks.
So in conclusion, our analysis showed that Media Prima Berhad is currently in a more stable financial position compared to Astro Malaysia Berhad. So Media Prima demonstrates a strong liquidity, lower leverage and a better ability to manage its debt, even though its profitability has declined slightly over time. On the other hand, Astro faces a higher financial risk due to a decline in asset efficiency, weaker earning and a heavy dependence on debt financing. So this comparison highlight how different media business model can significantly affect financial findings. Astro Malaysia Berhad should prioritize better debt management, improve asset utilization, and strengthen its digital services to support long-term performance. For Media Prima Berhad, the focus should be on maintaining profitability by expanding digital platform and reducing dependence on traditional advertising. Both companies need to adapt continuously to digital disruption and changing consumer preference. So that's all from us. Thank you so much.